Hi there, it's Grant here and welcome back to the Fast Track Options Trading Challenge. If you've been following along the challenge, watch the previous videos. We're now on video 5 and in this video I'm going to help you decide when to use a call or a put option. If all of this seems like utter gobbledygook, I'd advise you go and watch the other 4 videos that I put out for this challenge. I'll link to them below in the video. But if you've been following along, let's help you decide when you should use a call or put option. So with that said, let's get straight on with the video. So, big question is, when should I use a call or a put option? So when would you use a call option? So you would buy a call option for a stock if you believe that stock's price will rise above a certain point in a set period of time. So just to recap, you buy a call option for a stock that you believe that stock's price is going to rise above a set level in a certain period of time. Maybe, the company you're looking at, they're going to put out a really positive earnings report, so you think stock price is going to rise. If you believe that's the case, you buy your option and then ride the rise and then profit from it. Also, inversely, when would you use a put option or buy a put option? So you'd buy a put option for a stock if you believe that stock's price will fall in a certain period of time. So looking at the example above, just say you're following a stock and you believe in a week's time they're going to put out a really poor earnings report, which is going to make the stock fall. You would buy a put option for that stock and profit from that stock falling. So let's just look at how this would sort of play out with a visual representation. So if you remember Simon from the previous videos, in this example, he's going to buy a call option, which is represented by the blue line, and we're going to call that stock X. So Simon, in this example, Simon is betting that stock X is going to rise above $100, which is the strike price in the options contract. Just to recap, strike price is the set price in the options contract that Simon has. He can buy those shares at $100 at any time before the option expires for $100, no matter where the stock price goes. But Simon believes stock X is going to rise above the strike price in the options contract for the shares of $100, and he thinks it's going to rise above December 30th or before December 30th, which is when the option contract expires. And basically, in this example, the stock price of stock X rises up to $150 on some positive news put out by the board of a company, and which is exactly what Simon wanted, and this happens well before December 30th. And basically, this means Simon is in what we call the money. And when we say it's in the money, it means basically we've pulled off a positive or profitable options trade, and we can now, cash out that option in order to pull our profits. So what Simon can do now, he can either exercise the option and actually buy those 100 shares that are controlled by the option and cash them in for a profit, or he can flip the options contract and sell the options contract on the market and sell it for a higher premium than what he paid for it. Because Simon, to buy this call option on stock X, he had to pay a premium. Say, for example, Simon paid $150 premium, and if you remember, an option contract controls 100 shares for a stock. So basically, Simon paid $1.50 per share. So Simon paid $150 to buy this options contract on stock X. But seeing the price has shot up of stock X to $150, and he's still got time to, before the option expires, he can flip this options contract and sell it on the open market and get a higher premium than what he paid for it. So say, for example, he sells it and someone pays him $2 per share, hence he collects $200 and he's made a nice tidy profit of $50 just for flipping the options contract. So basically that is when you would buy a call option, and that is basically the two ways Simon can make his money. Now, flip side, Simon wants to buy a put option on a stock that will call stock Y. Basically, the options contract, it's got a strike price of $100 and it expires on December 30th. Pretty much same as above, but in this scenario, Simon is betting that the stock price is going to fall because he thinks stock Y, the board's going to put out some negative news about earnings, so this is going to make the stock fall. So basically that's what Simon's betting on, and lo and behold, I know the stock price is showing up or going up, but basically, we're betting that the stock, or Simon's betting that the stock price is going to stay below 100, and lo and behold, the stock price falls to $50 per share on some negative news. This is exactly what Simon wanted. That's why he bought a put option. He's in the money, and basically he can now cash out for a profit. He can either exercise the option and sell the shares that the option contracts controls, or he can sell the option and flip the option on the options market, let someone else buy it and collect a high premium, because obviously the option has value, because it's in the money, someone's going to want it, and he can collect a higher premium than what he paid for it, because the option is value, it has value. So basically that is when you would buy a call option and when you would buy a put option. So just recap, you buy a call option on a stock that you believe the price of that stock is going to go up above a certain level in a certain period of time, and you buy a put option on a stock that you believe is going to fall below a certain period in a set period of time. And this is basically the foundation of options trading. So well done for watching this video. We're really starting to motor now, and if you've watched the other videos in this options trading challenge, you're going to be getting a basic understanding of what options trading about, how to make money, and how you can start making trades. So well done for sticking or getting this far if you've been following along. So in video 6, this is basically what it's all about. I'm going to be looking at some options trading strategies. This is basically the secret sauce that's going to help you to become a successful and profitable options trader. Because if you don't trade with a strategy, it's a recipe to lose money. So it's very important to have a clear strategy that you can follow, so you can place profitable options trades. And that's what I'm going to look at in video 6 in the next video. Last thing I'll say, if you like the video, why not like the video, and why not subscribe to the channel to get more content like this. And also, last thing I'll say is I'm going to link to my favorite options trading courses and advisories, One Ticker Trader and Jeff Clark Trader, down below. Basically, these services help you get up to speed with options. There's options resources in there that give you strategies, show you how options work, what they are. But crucially, the teams will put out options trades that you can place that give you the best chance of making money options trading. I really like them. These services have really helped me understand and get up to speed with options. So if you want to check them out, I'll link down below, and why not check them out. Anyway, that's what I've got for you. I look forward to seeing video 6, and I'll speak to you soon.